Well, if there's one interaction I always look forward to, and our viewers also look forward to, both in terms of learning, understanding, and perhaps deciphering what is the way forward for markets, economy, risk-reward ratio, and the discipline in life, is Prashant Jain. To understand his view on markets, to understand his thoughts on value investing, and to understand that how life has changed for Mr. Jain in his new avatar. So let's discuss all that and much more with Prashant Jain on this edition of Market Maker. So nice to have you back. Thank you for joining us.
My pleasure.
Almost a year.
Yes.
Almost
yes,
a year.
Yes,
I think
yes,
July is when you decided to start your entrepreneurship journey.
Yeah.
So far, so good?
So all well, Nikul. We have done well so far.
As per your expectations, or?
Yes. No, I think we are on track. By and large, it's been smooth. We have been lucky. We are off to a good start.
So was it, do you regret the decision, or are you happy that you finally took that plunge a year ago?
No, I think it has turned out to be good. So I had a great stint there, and I have very good relations with everyone in the team, great respect for that organization. But I think they have done exceedingly well. The transition was extremely smooth. And so I think it's been good for everyone.
Good is a word I can use to define the markets also, right? It's been a good comeback by the bulls. I mean, just when it appeared that things were looking puffy-duffy, globally inflation scare was there, interest rates were not coming down, bulls have made an impressive comeback.
So I think yes, if you look at markets, last 18 months have been flat. They've been range bound. And that has led to, the time correction has led to moderation in multiples. And even globally, interest rates seem to have peaked, at least for the time being. I mean, I'm not an expert on that. So I do think that the risks have slowly got addressed. Valuations have turned reasonable. So I would say these are fairly valued markets. But still, I would say there is not much room for multiples to go up, at least in aggregate terms. So I would say broadly, returns should track earnings growth or nominal GDP growth.
When you're saying valuations are looking reasonable, I'm assuming that you are looking at historical benchmarks?
Yes, if you look at, in terms of PE multiples, typically I think 1 to 2 years forward. So in 3 months' time, we'll all start focusing on fiscal 25. So I think based on fiscal 25, markets are trading between 16, 17 times, which is reasonable. Which is not cheap, but it is not unreasonable either. I would say things are just about okay.
Is it a good idea to look at historical benchmark, because history and these conditions, when these PE multiples were there in the past, the conditions were very different. Liquidity, underlying growth of the economy, global interest rates. So is it a good idea to look at historical benchmarks and talk about valuations?
So when I look at historical benchmarks, I look at typically a 15-year average, because that does cover 1.5, 2 cycles. And if you look at 15-year averages, I think we are slightly above that. Our growth rate should improve hopefully as we go over the next few years. I think India is acquiring more and more prominence, visibility globally. It's becoming a large, fast-growing economy. Geopolitically, I think we are in a good situation. We are a good boy in the world. So I think given all of that, the size, the growth, I think a 16, 17 P, to my mind, appears to be reasonable. And it is also in line with slightly longer term averages, maybe slightly higher.
I'd like to draw your attention to what's happening to flows. For 2022, foreign institutional investors were big sellers. For the calendar year also, they've been net sellers. Now that we are the official big boy or the good boy in the world, what are the chances that this year flows could reverse, and in that the market P multiples actually could surprise us on the upside?
So Nikunj, that's about the only uncertainty that one is, if one is forced to mention. I think that continues to be a risk. But let us look at it the other way. When foreigners sold almost 40 billion worth of stock between, I think, September 21 to June 22, the markets held pretty firm. So I think the local flow of savings towards equities has changed decisively, and people like you have played an important role in that. So I think the vulnerability of the markets, at least from a medium-term perspective, to foreign flows would be far less, I feel. But that possibility can never be denied completely, because globally, I mean, inflation thus far has not come down as much as markets would have hoped, and some people talk of a recession. I don't think that impacts the economy in India, but it could impact the markets short term. But I would look upon that, should a correction happen induced by foreign flows, I would look upon that as an opportunity to buy an otherwise a very strong fundamental story.
Could the reverse be at play? That foreign institutional investors, yes, they've been sellers, then they continue to sell, but last 10-15 days the tide has turned, and now FOMO actually could hit them, which is that they could be forced to make a comeback.
So I think if you think slightly ahead, if you think 3-5 years, I think India could emerge, could enjoy larger allocation in the scheme of things for foreign investors. Because if you look at the EM basket, I think India is probably one of the best placed economies, countries in the EM basket. And I think therefore over time we should continue to attract bigger flows. So I would not, whether it is FOMO or whether it is whatever, but I think look at India, it's a 3.5-4 trillion economy growing at 6-7-8%, and it ticks almost all the boxes. So I would say that anyone with a medium to long term perspective would want to be not overweight India. I mean, they would want to be overweight India.
You've been a big advocatory of banks, and especially banks, big banks and banks which have a strong CASA and a big balance sheet. Now that trade has worked like a charm now. What was more like a consensus view has now become a consensus trade, which is overweight financials. But do you think even though it's a consensus view and a consensus trade, the consensus prices has not reached there?
So I think, yes, most people agree now that, and the stock prices have moved sharply. So most people agree that banks are in a sweet spot. Balance sheets are very clean, credit growth is reasonable, and profitability is holding up well. So I would say these banks should continue to do well, and the gap in valuations across banks, the earlier what we used to call the retail banks and the corporate banks, that has now converged, and actually that divide is becoming less relevant now, because the asset side of almost all the large banks is increasingly looking similar to each other. So I think the re-rating part of the trade has played out to my mind, but this represents a sustained growth business. So I think one should be able to make returns in line with the earnings growth, and banks, I think, should grow their earnings medium term slightly ahead than the Nifty. So to that extent, I think there is still room for some outperformance there.
Who has the right to win in the financials?
My vote would be for the large big brands that have scale, that have good technology platforms, that have a good CASA mix, and so my vote would be for, I mean, that's an obvious one, and there could also be other smaller niche companies which can do extremely well, like some small banks are doing quite well. But this clearly is the biggest piece where I think the outlook is quite decent.
You started buying into State Bank of India when they reported a record loss like never before, I think 6-7 years ago. For the quarter gone by and for the year gone by, they've reported a profit which is at a record number and the second highest in the history of any corporate. What is the trajectory for, let's say, a bank like State Bank of India or ICICI Bank, and what makes you so bullish?
In fact, I used to discuss with many people that State Bank will do more than 50,000 crores profits, and they used to joke, but then they texted me back, look, you were right. So I think the bank has done extremely well, and other than one product category maybe or two, they have actually not lost a share in any of the products. So I think it's a really well-managed bank. The technology platform is extremely good, and with every few years they improve. So I think it's a future fit bank. They should continue to do quite well, and as I said, large banks that have good technology platforms, think of it this way: when you enter the world of digital banking, a large bank is in a great position to write a very small loan or to write a loan in a remote location also, because it is technology that is working for you. So I think the current digital banking environment, the digital environment, it favors the large banks immensely. The limitations of physical space and resources is gone, and they are best placed to leverage this environment to my mind.
One theme which you've liked in your previous avatar was defense manufacturing. These stocks are commanding P multiples of consumer stocks now. Do you think from a market standpoint this entire defense manufacturing or railways manufacturing has been played out?
I think again, in terms of the multiples moving up, they have played out. See, 2 years back these stocks were between 5 to 7 multiples, and today they are anywhere between 20 to 25 multiples. So I think the multiples re-rating has happened, but these are highly sustainable businesses. They have many growth tailwinds, both support of government, focus on indigenization. And I think the Ukraine war has also highlighted that you need to maintain large inventories of ammunition, because what you produce in a year can get consumed in a matter of days. And I think India also offers you competitive pricing for the technology what we deliver globally. I think the exports opportunity is also there, though it is smaller compared to the domestic opportunity. So I think again, coming back, it's in a similar position as the banks. The re-rating has happened, multiples are fair, but you can make some money as the earnings or the business continues to grow.
But Mr. Jain, if I look at let's say an HAL or BEL or for that matter Kochi shipyard, the order books are strong. But again, I just want to remind our viewers that ultimately to execute these order books, it could take 3 years or 4 years to build an aircraft. It could take 5 to 7 years to build a Navy ship. So right now, yes, these businesses are growing purely on basis of order book, but eventually these are long cycle businesses. So how does one go about investing in them?
No, you are absolutely right. So I don't think these are rapid growth businesses. The order backlogs are very large, could be 5-7 years of turnover also. But the way this business works, I mean, you are absolutely right. To build an aircraft, or you have a number of aircrafts on order and you will deliver a certain number per year. So these order book will get exhausted over the next 5 to 10 years. That's why I said, I mean, these are businesses that can, but they should still grow. I think between 10 to 15% a year they can grow. And if you add back the dividend yields, that will become a reasonable return. But I would agree, by and large, that the scope for further re-rating is not there.
So what, to your mind, is at the threshold of getting re-rated? Whether it happens this quarter or next quarter, that no one knows. But do you think there is a significant scope for that business or sector to get re-rated?
So I think one space which has also got re-rated, but I think there could be still some scope for it to get re-rated is the power sector. Because go back 2 years and ESG was a very live theme, and the world thought that you can transition from conventional to new energy overnight. And we have discussed this number of time, that was not a very realistic view. But I think people have come around to that view, that conventional power is here to stay. And world over you are seeing what is happening in the power space. Even in India, it is now possible shortages of coal or power that make the headlines. And recently, I think there were some reports that we are likely to announce fairly large new conventional power plants. So I think India's, as I have always said, India's per capita power consumption is extremely low, and power represents a growth business in India. And also, I think some of the incumbent companies, they are their quasi-sovereign status gives them a significant advantage when it comes to borrowing. And whether it is in conventional or in renewable power, the cost of borrowing is the biggest delta between two businesses. So I think the widening of spreads globally and even in India to some extent, I think has enhanced that competitive advantage. So I think these utilities are still not trading like growing businesses. So I think there is still some room for re-rating to take place there. But by and large, I feel there is not much scope in this market, to my mind, for multiples to go up in many places.
Which means if you are of the view that markets will grow in line with earning estimates, let me ask you that what are your assumptions for earnings growth for next 2-3 years?
I think, Nikunj, our profits have recovered strongly. India's profits to GDP had fallen to under 1.5% 2 years back. And that was due to NPAs, low commodity prices, weak capex. So we have what we lost in 5-7 years, we have recovered in 2 years. So today our profits to GDP is almost back to 4.5 to 5%. Whether it is banks, commodities, capex companies, consumer, IT, pharmaceuticals, chemicals, metals, utilities, almost everyone is making decent money. So I would say there are very few places where margins or profits can grow faster than top line growth. So I would say a 12 to 14% profit growth is what appears to be sustainable, not more than that to my mind. So unless India's growth rates move up.
So 12 to 13% or 12 to 15% compounding return for equity as an asset class for 3 to 5 years should be a reasonable expectation.
I think, yes, 12% is a very realistic. I think could be slightly more also. I think what is exciting is that India's real growth, which has averaged roughly 6% for last 2 decades, I think that could move to 7-8%. Because what has happened, India has gained competitiveness in manufacturing. India's wage inflation in Asia has been one of the lowest last 10 years. So because we have not done well in manufacturing, if you look at Vietnam, Indonesia, their wages were less than half of India 10 years back. Today they are slightly higher. So because we have not done well in manufacturing, we have gained competitiveness due to lower wages in manufacturing. And apart from that, the large global corporations want to de-risk their supply chain from over-dependence on a single country. And also because of geopolitical reasons post-Ukraine, India is a favored destination. So I think India's time in manufacturing is finally coming. And manufacturing is a much bigger opportunity than services. So just 0.5% of global manufactured exports, just 0.5%, is 4% of India's GDP, which is roughly the same size as software exports out of India. So I think India's growth rates of 6-odd%, I think current decade and next, I think we should be able to grow between 7 to 8%. And should that happen, then of course there is slightly higher room for equities to grow.
So let's spend some time on manufacturing, because I think from 2019 onwards you've been using the word electronic manufacturing. Nobody ever thought that India could be a net exporter of mobile phones, but you saw that coming, and today we are a net exporter of mobile phones. Defense and railways are government-backed manufacturing. You're trying to create a moat by putting import duties and incentivizing them with PLI schemes. But the real proof of the pudding would be when we are exporting to the world. Which categories of manufacturing do you think in India can really fill that gap where we can be the factory to the world?
So I think we have a very big opportunity because we have land, labor, power, technical skills, supportive government, entrepreneurs. In barring the electronics space, where we are yet to create an ecosystem, and we are essentially assemblers right now. But I think barring that, our ecosystem is also reasonably well developed. So I would say whether it is textiles, whether it is engineering goods, whether it is chemicals, pharmaceuticals, in all these spaces, whether it is automobiles. Look at what Mr. Bhargava said recently. He said new plant dedicated towards exports. In two-wheelers we have done extremely well. So I think all spaces of manufacturing by and large other than electronics, I think we have reasonable capability and we should do quite well, and we are moving in that direction. I think in electronics you need government support because we lack scale, we lack expertise, and we don't have a ecosystem. So right now you are starting from the finished product, you are assembling the components, and slowly I think we will work backwards as more and more capital goes in that space, whether it is driven by local entrepreneurs or by global companies. And government also is extremely keen on developing that ecosystem. But I think other than that space, we are reasonably placed today also. And in that space, we have a lot of work to be done.
So let me try and divide your thoughts into categories: cyclical, structural, and value. I think banks will qualify as something which is the structural part of your portfolio. You've been owning banks and you will continue to own banks. We've discussed that. Now let's understand the cyclical part, which is that, Prashant Jain is known for buying out-of-fashion stocks. You've not shied away from buying IT at a decline or pharma when they were out of fashion. What is the cyclical bet in your portfolio, and where do you think there are opportunities there?
So Nikunj, this is a unique market, and in my career over 3 decades, there was some sector or the other which was always offering good value, where you could make money not just on growth but also on multiples going up. But first time I am facing an environment where I don't see meaningful scope for multiples to go up in almost any sector. So I think this is a phase of the market. Something will change over time. Some opportunities will emerge. But in this market, profitability is optimal. Valuations are quite optimal. Some sectors which are very expensive, let's say IT, they have derated significantly. Only the consumer space is still one sector where I think the multiples could derate even more. The derating has not been enough. But other than that place where potentially multiples could go down, and the utilities, the power stocks where multiples still have some upside, I think by and large these are fairly valued markets even across sectors.
Even in pharma?
Yes, I think pharma has derated sharply, but I think for the right reasons, because US markets have been very challenged. Most companies are not making money. I think capital allocation also in some cases is not to the market's liking in the pharmaceutical space. So I think even, I would say it is now looking like rightly valued even pharmaceuticals. I don't think there is great value or great risk even in that space.
They say in Hindi that सुबह का बोला शाम को वापस आता भोला नहीं बोलता. I'm referring to consumer tech and fintech stocks. They've realized that when you are a private, when you're dominated by private investors, then when you come into the auction market, the rules are different. You were playing kabaddi, now you have to play cricket. Do you think these promoters and these managements have learned enough?
I think the environment is very clear, and things have changed overnight. So I think you can see it in their actions also. Now, whether that is good enough or no, time will tell, because to bring down losses will most probably lead to a sharp deceleration in growth, and that poses its own set of challenges, because these organizations are not wired that way. So I think it would not be proper to generalize in this space. I think there are many good companies, many good entrepreneurs, and I think that is good. That is one big thing that has changed in India, that the newer generation is willing to experiment, they are risk takers, and we need entrepreneurs like these to take the country forward. But I think some will of course fail their own expectations, their market expectations, but I think some companies will definitely come out very, very strong, because the fact is that the consumer has moved. He is spending more and more time on digital things. So I think some great businesses will come out of this.
Have you bought anything?
No, I have not.
But if I have to summarize today's interaction, can I say the playbook on which Prashant Jain always bets on, that he likes to buy companies at a reasonable price, bet on businesses which may not get disrupted in the future, and then believe in the power of compounding and with a lot of patience which has to be bundled up?
No, I think absolutely. I mean, I would love to buy businesses at distress value. Why fair value? I mean, if you get distress value, it is great. But in this market, I don't think there is any distress value anywhere out there.
So to close it up with Buffett, at the Berkshire Hathaway annual AGM, he said that AI cannot replace human intelligence, and you feel that?
I feel that, but I mean, as I said, technology surprises us many a times. So I will not bet on it, but I do feel that what Mr. Buffett says appears quite reasonable to me.
I'm tempted to ask you one more question on Bill Gates. Bill Gates, one of his favorite quotes which I love is that we always overestimate the rate of change in the short term and underestimate in the long term. Where do you think markets are overestimating the rate of change, and where do you think they're underestimating it?
I think consumer sector, to my mind, is a case of at least many businesses in consumer sector. I think the implied growth rates are probably being overestimated, and I think in the power space, the implied growth rates are being underestimated.
So give me a quote of Prashant Jain, then we'll wrap the show. Really appreciate your time.
Thank you so
nice
much.
to have you, Nitina. Thank you for joining us.